The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but is a passive investor with no day-to-day operating requirements and whose liability is limited to the extent of their share of ownership. The limited partner has the maximum leverage on their most precious asset, their time. Now, they say you're the average of the people you surround yourself with. Are you looking to elevate your network? Connect with individuals that bring your average up? This is more than just a podcast. It's a community to learn, to participate, and to connect. There is no other community out there like this specifically for limited partners. So subscribe to the podcast, and most importantly, join the community at thelimitedpartner.com. Welcome. I'm your host, Jake Wiley. Welcome, partners. This is your host, Jake Wiley. This week, I'm joined by Dave Holman of Katahdin Property Management. Dave, thank you and welcome to the show.
Thanks for having me, Jake. Excited to be here.
Well, awesome. Yeah, I'm excited to hear kind of your journey here and then talk a little bit about your property management business. But I guess let's start off. Let's get a little bit of background about you. Tell me about your journey. How did you get to where you are?
Sure. Circuitously with lots of new starts and dead ends and things like that. So I was, from Portland, Maine area, grew up here, ended up going to college out in Minnesota. I think I took one econ class in my entire, college, high school education. I wasn't thinking about, starting businesses. I didn't know what a limited partner meant or anything like that. But I did get interested in green design and green building. And I took some architecture classes in college and spent the next 4 years down in Bolivia in South America, like most of us always do. Ended up starting a chain of camping stores down there. My then girlfriend, now wife, who I had met there, so she's Bolivian, and that's what led me down there. And by the time we had 3 stores and 10 employees, I figured I need to learn something about, business and economics. Clearly, enough of it's intuitive that, you don't have to have a degree to do these things. But came back to Maine in 2009 and got my MBA, here at the University of Maine in Portland, and met the person who ended up being my business partner in like the first day of my first class, Brian Sprague. He's a retired Navy officer who was getting his MBA at that time. And, we just bonded over beers after class and kind of tracked together throughout the program and stayed in touch afterwards. And a while later, when I had a full-time job and had, 32 units that, other people were managing for me while I was doing that job, I really knew that I had to start my own management company. So I reached out to him and he was crazy enough to accept. So we formed Katahdin Property Management, Katahdin being the name of the mountain that ends the Appalachian Trail. We're both really into hiking here in Maine. So it was a good fit for us. And we now have 6 employees. We're managing over 130 units, and that's growing pretty quickly. About 2/3 residential, 1/3 commercial. And I got into real estate in 2011 as a limited partner. My best friend from undergraduate reached out to me. He had become a developer. He had started working with this group of developers in Minneapolis. And, he sent me this, friends and family offering, which, again, I knew nothing about 506B or any of these sort of, things now. And I had done stock investing and I knew that, 6, 7, 8%, is a pretty good return on average. And this, private offering was offering like 18% returns year over year when you combine the cash flow and the appreciation. And I just thought, that sounds kind of like a scam or something, but I trust my friend. I know him well. I know he wouldn't be associated with, fraudsters or whatever. So I said, you know what, I'll give you, this little inheritance I got recently. Here's 20 grand. If I keep it, I'll just spend it. So I better invest it. Here you go. And sure enough, they started giving out quarterly reports as they were building, this 100-unit apartment building in Minneapolis. And then I started getting, dividend distribution checks every quarter as they filled it up and over the years. And that got me interested. I learned about it, got me into real estate investing. And then I started up here in Maine with just a single family home, partnering with family, and then another one. Then I bought my own 3-unit and started partnering with other investors to buy bigger and bigger buildings. And, so I've now been a GP, a general partner on 5 syndication projects of larger real estate investments where I've, pooled capital among friends and family and other folks, and bought some pretty neat buildings in downtowns, here in Maine. So that's basically bringing you up to speed. And now that same friend from Minnesota and I are working on a new construction project here in Maine. So that'll be my first new construction. Everything I've done up to now is value add, historic renovation style buildings.
Man, that's really interesting. So outside of your partner that you met at MBA school, are you using any of your MBA skills currently?
Yes, every day. I would say, there's two areas that to me are very critical. You don't have to learn them in school though, but one is organizational development, AKA team building, how to be a good boss, how to attract really talented, hardworking, people to your team who could get paid more elsewhere, being a sort of quality of life business. I mean, that's my goal. And I think we're succeeding in that, where we now have what I consider to be a really star-studded cast of people who are all kind of smart, high performers, smarter than me, and they're out doing stuff with us, even though any of them could probably go out elsewhere and get paid double what they're making with us, because A, we're offering ownership in some of the buildings we're buying, which is kind of neat. And B, we're doing this in a fun and humane way. They can work their own hours. There's a lot more flexibility in what we're doing than what I think a lot of 9-to-5 jobs, can offer. So organizational development, is a huge one. And then statistics. My senior year of undergraduate, I took, I was forced to take a math class. They weren't going to let me graduate without it. And I took, the standard, statistics for dummies called applied statistics. Turned out to be one of the best classes I've ever taken, recommended to anyone. Just being able to think in terms of probabilities and understanding the meaning of those probabilities. And I mean, that alone is far more useful math than any, calc or trig, to the average person. And that was a very eye-opening class that's helped me a lot in real estate investing.
I think that's a good tip there. Statistics, demographers, there's so many things that impact the value of a property going forward that are not necessarily tied to the current operations. And I think that's a really good point. In terms of, you mentioned green design and building. Are you using any of that in your current projects? Absolutely.
Yeah. I mean, about 40% of global emissions are real estate based, either from the operation of real estate or the construction of real estate. So we are the problem and we need to be the solution, and so what I like to do with buildings, I'm developing a playbook that works very well up here in Maine, which is that, we've relied on oil as the primary heating fuel, for the past 80, 100 years. And it's getting increasingly uneconomical to do that. And it's a risk, basically. It's a pain point. Right now, people that are relying on oil are, paying through the nose compared to even last winter. And that's a major problem. So, and a lot of the reason you need to heat a building is fixable, with stuff called insulation. So if you're a landlord who is paying the heat for your tenants, insulation is going to be your best friend. And every dollar you invest into insulation is probably going to earn you 10 or 20 in terms of driving building value through, increasing your NOI, lowering your expenses, and just straight up lowering your heating bills. I mean, usually when I insulate a basement or an attic, I'm seeing a 50 to 100% annual return on that investment right away. But it's not sexy. You can't see it from the outside. It's not really something people brag about. Oh, my attic is R60 insulation. You don't hear that. But it matters. I mean, it really matters. And it's if you don't do it, you're literally throwing money out the window. But it's just something a lot of landlords and managers, they just take what they're given. They say, oh, okay, the heating costs $6,000 a year. It's oil heating. Great. I'm going to pay that forever. They're done. They don't think about it. They don't think, oh, wait, could I switch to heat pumps and take that $6,000 off of the landlord, put it on to tenants? That actually lets me either keep the rents flat or even lower them a little bit. I get better tenants. I'm more competitive. And my NOI looks a lot better. And I have an amenity that tenants really want, which provides AC and dehumidification and filtration and all these great things. So, looking at heating and cooling, I think, is a huge part of what we need to do, as property managers, as real estate investors in the future.
Yeah, I think that's a really good point, really, to focus on too, is that as you think about the future of the value of properties, there are a lot of things, like oil costs, like you have no idea what that's going to be, next week, much less 5 years from now. There are things that investors are now looking at, like ESG. We've talked about it on some other shows, but it's important, right? They're making long-term bets on properties and the values and how these properties are built and constructed and where they are. on what the value of that property is going to be down the road, because if in your example, if you're the landlord and you're paying $6,000 a month in heating cost, right? And then oil prices double in the next year, which could happen, right? That's now 12. And that's completely, you can't model that, right? I mean, you can, but you can't expect it. And that's real.
Yeah, it is funny when we make performas, you just see everyone with a linear 3%.
That's right.
Extrapolation of income and expenses or 2.8 or whatever people want to use. Reality is never that. It's always different in different ways. And I think we're heading into an era of inflation where 3% will feel tame and ludicrous. I mean, I think certainly in our area, expense and income and rent, inflation has been running in the 8 to 12% range per year for the past 5 years. And now it's in the 20 to 30% range. So to think that 3% is an accurate pro forma is tricky, because that's what the banks and the appraisers still want. They're not going to change their ways just based on an errant year or two yet, but it doesn't model reality in the right ways. So, I think we're doing more, scenarios, looking at just different extremes and making sure that on the bad extremes, hey, what if interest rates go up, a couple hundred basis points to deal with this inflation? That's going to affect some projects. So I think that would be an important question, for LPs to ask of GPs, how are you looking at interest rates? How are you looking at inflation of expenses and these kind of things going forward? But ultimately, operating costs are not a sexy part of business, but they're critical. And it blends perfectly with ESG, because we're all just looking at efficiency. And, efficiency is what is going to drive profits. And the more, efficient we can be and use less heat to keep people cozy, the better. And that comes down to design. If you can design a building with lots of south-facing windows and lots of insulation, and you plan to have a long hold period, you're going to reap the benefits of whatever extra you're probably paying up front in terms of lower operating costs. And ultimately, better appraisals, better cash out refis, better sale at the end of the day.
Yeah, I think, this may seem, for our listeners, this may seem a little bit like a tangent, but I think it's a really important point. As you think about an investment that you're going into, and in this example, we're talking about real estate, there are certain assumptions that are built into a model for the property, for the project going forward, that you really need to get your mind around and understand that, you might just see like a steady state. They're accounting for inflation or increases in costs, and it's 3%, and it's modeled every year and you can see it. But there's a lot of things that are unknown. And from an operating perspective, and the best operators are trying to figure out a way to take the unknown and make them known. So, in a prior life, another good example is I was in renewables. We did solar, and we had developers come talk to us about solar on large multifamily properties, because they're like, hey, look, we don't know what our electric bill is going to be next year. And if we can model this out and we can put solar on it, we can predict to a certain degree, a high likelihood, here comes your statistics again, the sun is going to shine. Then we can model out how much electricity we use and how much we can do in insulation. And then we can start making what they call an uncontrollable cost a controllable cost. And that makes a big difference in your ability to sell this project down the road, because you can actually look at the numbers and say, these are real. You can't have somebody poking holes in, your models and your projections. But as an LP, I think as a passive investor, I think you're bringing this point to light. There are certain things that probably just get glossed over that are unsexy, that if you spend a few minutes looking at and understand, hey, here's some risk, right? Energy prices, any of the other operating costs that just have these subtle 3% increases, anything that has to do with wages right now, right? That I would be very, very leery of small 3% increases in wages, because that's not where the market is right now. So great points.
Absolutely. I think in the real estate environment, the clear and obvious trend, at least to me, who's, trying to look at this with binoculars, is towards electrification of everything. Fossil fuels are just not going to be a part of building construction in 20 or 30 years from now. And so, as you're buying buildings and building buildings, do you recognize that, and do you chart a path towards that? Because to your point, the baseload electric generation prices in the US are not spiky. They're very stable. They're on an upward trend in most places, but they're going to be a very safe bet compared to, natural gas, which relies on fracking, which relies on, laws that politicians could change. It relies on just the easy supply. It relies on investment in big companies. It relies on international politics and Russia and, all these different things that are way out of your control. Whereas baseload, electric grid pricing is going to be pretty stable and hopefully be driven down as we get sort of small nuclear back into the picture, as we get solar and wind, ramped up, and seeing better, economies of scale in those, technologies. And I think working them into buildings is great whenever you can, because you're going to control your costs, and that'll make for, more profit down the road, but you're also doing the right thing environmentally. Your building is not a source of, pollution and, lung cancer. That's a pretty important thing too.
Yeah, great points. And I think, as we kind of transition here, I want to get into some of this property management aspects of it because it's important. Is the property manager, if for a limited partner that's investing in a real estate deal, property management is one of the key aspects and really one of the key team members that your GP needs to have in the picture. I'd love to get, you're obviously in the space, so let's talk a little bit about that.
Yeah, I couldn't agree more. I think the property management can make or break your investment. I think a good manager can make a lackluster property perform well. And more importantly, vice versa, a bad manager can make a great property perform poorly. And right. So those are the ones that I've seen LPs get burned on. And I luckily have not personally been burned on a project, but I just met with a very experienced investor who's done dozens of syndication investments. And one of his first, the property manager was inappropriately just taking a lot of profits, and they were marking things up and they were using it as a way for them to generate extra income and, allocating expenses inappropriately. And that is something that is really tricky. I think anytime you're making an investment, the most important thing is looking at, the GP side and being sure that they're going to work with responsible people. And inevitably, anyone who's in business is going to come across bad contractors, suppliers, partners at some point or whatever. And that's not a question. The question is, can you recognize it and can you, fix it quickly? But I think as a property manager, I started managing things myself. Then I went, I inherited one when I bought, 27 units. They came with a property manager. So I was like, okay, ain't broke, don't fix it. I'll just keep him on. And I was like, oh, it kind of is broke. Right. I'm getting like C's and D's. And I want to get A's, So I went to a company that I thought would be better, a third-party management company, but they were not very tech savvy and tech forward. They weren't great at their bookkeeping. And very quickly things got backed up and I could see that this was not the solution for me. And I had heard from a friend, who's the syndicator in Minneapolis, that they have their own property management and they do it to control risk. Just like they do, with energy prices. For me, having my own property management company is my primary risk control method. When a tenant reports to me that stairs are loose or a railing is loose that they're using to get up and down, we can fix it before they break their skull and have $1 million lawsuit on hand. If an apartment is vacant and we want to fill it, to get a better return, we can set the price lower. We can give incentives. We can do extra marketing. We can control those variables. Whereas when we were in the hands of a third party, it was managing the manager, and I was not finding the experience to be very fulfilling. I think there's great third-party managers out there all across the country. You need to find them and work with them if you're going third party. And there's great, in-house managers across the country. And the people, to me are the key piece of it. If you have good leadership in those positions who are trying to run a sustainable business based on long-term relationships, they're not just in it for themselves and out to squeeze every ounce of profit out of things. That's a good sign to me that, you're partnered with the right people.
Yeah, and there's a lot to property management as well. Like one being, are they in your space, right? Just because somebody does commercial real estate and they're focused on offices doesn't mean that they're going to be good at multifamily. As a matter of fact, it means they'll probably be terrible. And then two, thinking about multifamily again, right? Because that's kind of the path we're on. If you're renting out or leasing out an A apartment versus a B or a C, it's a different process. It's a different marketing tool. There's a lot of differences. So I think when you're looking for your property managers or you're talking with your GP about the property manager, just asking some questions about like, okay, great, you found somebody that works in the space. What have they done before? Right. If you go look at the apartments and the communities and the neighborhoods and everything looks very similar, like that's a great sign. If you look at them and they're all like D units or they're all A units, like I think there's some questions that you need to ask.
Absolutely. Yeah. You need the right mentality and philosophy, that aligns with what you're trying to do. And, our company, we manage for some third party folks and we take on, extra units, but we also say no, depending on the situation, because a lot of we're not interested in working for a slumlord. Yes, we could make money by working with someone who is a little bit slippery, but it's not worth it, to us to do that. Whereas some companies will take, whatever comes flopping over the side of the boat, whether it's legal catch or not. We're in Maine, so we have to use like lobstering metaphors for everything. But I think it's really important that you understand the niche you're in. We operate across a lot of different asset classes in our company because those are just the kind of buildings I've bought and need to manage. And I would say that one company can do great across, every single asset class, because ultimately you need to be a good customer service, agent for the tenants. And, the leasing is different, but ultimately the customer service is pretty darn similar, where if they have a leak, it doesn't matter if it's a class A apartment, class D, or a retail store.
Right.
You better go get someone to fix the leak quickly, if you're a good manager. So the operations side of it, I think is very similar. Whereas to your point, the marketing and leasing is quite different. But I'd rather work with someone I trusted who's a generalist than kind of get burned by a specialist who's not going to deliver on what they're promising or not putting me in a high enough priority in their list of priorities that the performance, will justify it. And frankly, we're in a small market, so we have to be diversified. There's not enough, retail spaces to have just a retail manager in our little area. I think most of the companies that, I see here are pretty diversified. And I'm sure that's true in, all the sort of third tier cities and markets around the country. And the bigger ones in Houston, you absolutely can get someone who's specialized in Class B multifamily, and that's the bread and butter. And, there's someone else that does the industrial and the retail.
Yeah. And I think another point that you brought up, which I really like, is that a great property manager can take a poor asset and turn it into a great one. And the reality is that probably 90% of the deals that you're going to look at as a GP or an LP would be a value add, right? You're looking to take a property that's underperforming and get it up to its maximum potential. And you need somebody that can do that.
The management is critical. That's how I've been able to be successful as a syndicator. It's very hard to find buildings that are just a discount, a deal. The seller just didn't realize how much they should have charged for it. Once in a blue moon, you'll get that. One of the secrets to getting it is if it's listed with a broker who is not a specialist in that asset class.
Right.
So if you've got a residential broker doing a commercial property, that's when I get to feast.
Right.
Because they don't have, the pro forma worked up in quite the right way, or they don't know what the market rents are for office or these kind of different things. But in general, the property's the property, and you can only add so much value physically, to change that. But a lot of times the leases, the management, the way they're constructed, that is where you can move the needle on paper very quickly. You don't need to wait years and years and those kind of things. If your leases are all either month to month or 1 year type of situations, especially in residential, we see this where people are 50% under market or something like that. We don't take a hatchet, we take a scalpel and we say, okay, who can get close to market? Who is really, grandma on fixed income and is not appropriate or possible to get them there? And then how do we, make those, directional decisions of who's staying, who probably needs to move on, and that sort of thing. To me, it's a very human-based, nuanced thing that if you're coming in and just ripping everyone out of the building because they're under market, that's not the kind of project I want to be involved with, even if it's the most profitable. It's not good for the community. It's something that, and ultimately, I don't think those are the most profitable. I've found that, hey, for me, we're 100% occupied residentially right now. And that's partly the market, but we were that way, or close to it before the market got really hot. And it's because we're very thoughtful about who's going where and how to do it, rather than, okay, here's the formula for this building, just go follow it. And
right.
You get kind of, underperformance when that happens.
Yeah. And I kind of wrapping up this topic, because I'm really passionate about property managers, because I've had some single family residentials on my own where we've gotten the either flat or 3% increases because that's what the tenant could bear, quote unquote, from the property manager. They never even looked at market, right? So you get years down the road when you go renew the lease and all of a sudden you're at 50% higher rents. You're like, well, what happened? Like, what happened for those years in the past where I got nothing?
Yeah, no, I that happens a lot. And we build our leases to incorporate, if neither side does anything, there's an automatic greater of 3% or the local CPI, is calculated by the Fed, which is nowhere near the real market rent increases. But generally speaking, we're not always trying to get our existing tenants, up 30%. If market went up 30%, we're content to do the 6 or 7 that CPI is showing right now. And then when there's turnovers, we get it right up to market. But we're not just keeping it flat at 2 or 3. And that would be advice I'd give to everyone right now, is if you haven't been writing your leases to be the greater of, X or CPI, you better start, because CPI is not going to be 3%, this year and probably next. So you're losing. And I've seen buildings that I didn't buy them and they were a terrible deal because they were kneecapped by 20 and 30 year commercial leases that had a 2% escalator. And it translates to within 10 or 12 years, you're way under market and with no hope of getting to market if that tenant stays.
Right. Well, I guess to wrap up the show, I always want to focus on gratitude because I think it's really important. And bringing to mind somebody in your life that's helped you get to where you are. Who would you like to give a shout out to?
Yeah, that's great. I appreciate you doing that in the show. And today I'll give a shout out to Mike Line. He's a local developer who kind of with no profit motive or incentive of his own kind of took me under his wing when I had admittedly gotten out over my skis on a project that was very complicated, historic tax credit renovation, very complex project that he had a lot of experience with. And he was just very friendly, very helpful, generous with his time. So, chancing into people like that who can kind of be a guide and a mentor, has been terrific. I think that's helped me get where I am.
Well, awesome. Well, hopefully Mike will hear this, but Dave, thank you. This has been a great show. I've learned a lot. I really appreciate it.
Definitely, Jake. Thanks for having me on and thanks for this opportunity.
Absolutely. I hope you've enjoyed this episode of the Limited Partner Podcast. Please subscribe and leave a review. If there's any reason you wouldn't leave us a 5-star review, please email me at jw@jakewiley.com. Your feedback is always appreciated. The show is just the tip of the iceberg in terms of the limited partner community. It's a community where limited partners can come together to learn about what best in class looks like and opportunities, and most importantly, a place to connect. There is nothing out there like this, so head over to thelimitedpartner.com and sign up. We'll see you next time.